If you're in your 30s and wondering why your bank account isn't growing despite earning decent money, you're probably making one of these 5 wealth-destroying mistakes. I'm about to show you the exact errors that keep most people broke in their 30s, and more importantly, how to fix them starting today. Let's jump straight in with mistake number 1, not maximizing your pension contributions. Here's a shocking fact. If you're earning $40,000 and only paying the minimum 5% into your pension, you're literally throwing away free money. Your employer matches contributions up to a certain percentage, often 6% or more. That's an instant 100% return on your investment. But here's where it gets worse. You're also missing out on tax relief. Every pound you put into your pension, the government adds 25% back as basic rate tax relief. So if you contribute $100, it actually costs you $80. So if you're a higher rate taxpayer, you can claim even more back. A 30-year-old contributing an extra $200 per month could have an additional $180,000 by retirement thanks to compound growth. That's a house deposit right there. Mistake number 2, keeping all your money in current accounts. I get it, savings accounts feel safer. But with inflation running higher than most savings rates, you're actually losing money every year. Your $10,000 sitting in a 1% savings account loses $200 of buying power annually when inflation is 3%. Meanwhile, the FTSE 100 has averaged 8% returns over the long term. I'm not saying put everything in stocks, that's risky, but ignoring ISAs and simple index funds means you're guaranteeing your money loses value. Start with a Stocks and Shares ISA. You can invest up to $20,000 per year completely tax-free. Even $200 monthly into a low-cost global index fund could grow to over $300,000 by the time you're 65. Mistake number 3, lifestyle inflation. This one's sneaky because it feels like success. You get a pay rise, so you upgrade your car, move to a pricier flat, start eating out more. Suddenly, that extra $500 monthly is gone, and you're no better off than before. The wealthy do the opposite. They live below their means and invest the difference. When you get that next pay rise, try the 50-50 rule. Spend half on lifestyle improvements, save, and invest the other half. Your future self will thank you. Mistake number 4, not having an emergency fund. I know. Emergency funds are boring. But here's what happens without one. Your boiler breaks. That's $3,000 on a credit card at 24% interest. Your car needs major repairs. Another $1,500 borrowed. Suddenly, you're paying hundreds in interest monthly just to cover life's curveballs. Aim for 3 to 6 months of expenses in an easily accessible account. Yes, it might only earn 1 to 2% interest, but it's insurance against going into expensive debt. For most people, that's $5,000 to $15,000. Build it gradually. Even $100 monthly gets you there eventually. And mistake number 5, buying stuff that loses value instead of assets that gain value. That $8,000 car loan, the latest iPhone on contract, designer clothes, these things drain your wealth. Meanwhile, you could use that same money for a house deposit, shares, or even upskilling yourself. Here's a simple test. Before any major purchase, ask yourself, will this be worth more or less in 5 years? If it's worth less, think twice. If it's worth more or generates income, that's an investment. The average person in their 30s has $3,000 in savings but $8,000 in consumer debt. That's backwards. Focus on building assets, things that put money in your pocket, not take it out. Your house, your pension, your ISA investments, your skills, and education. These create wealth. Everything else just looks like wealth. Here's your action plan. First, check your pension contributions tomorrow. Increase them by whatever you can afford, even if it's just 1% extra. Second, open a Stocks and Shares ISA and set up a monthly direct debit. Start small if you need to. $50 monthly is infinitely better than nothing. Third, calculate your monthly expenses and start building that emergency fund. Fourth, next time you get a pay rise, save half of it automatically. And fifth, before buying anything over $500, ask yourself, is this an asset or a liability? Make these changes, and you'll be amazed how quickly your net worth starts growing. The difference between financial stress and financial freedom often comes down to these simple fundamentals. If this helped you, subscribe. We post money tips every single week.